inflation abated in February 2014 with annual headline and core inflation declining to 6.7% and 3% from 6.9% and 4.6% respectively in January 2014. Annual non-food inflation was also declined to 4.8% in February from 5.4% in January 2014. Although annual food inflation remains high, having declined only slightly from 10.9%. The decline in inflation was largely driven by the strengthening of the exchange rate, which over the 12 months to February 2014 had appreciated by 7%. The Bank of Uganda forecasts that annual core inflation will be in the range of 4.4%, 5% in the next few months, while increasing to between 5.5% and 6.5% over the next 12 months. Nonetheless, there are potential risks of stronger inflationary pressures, including those arising from possible further exchange rate depreciation, stronger domestic demand, especially from the fiscal sector, and an increase in food prices on account of the current drought and regional food supply shortfalls. The magnitude and timing of the possible declines in foreign aid are also a source of uncertainty for the balance of payments and the economy. Real gross domestic product growth for 2013-2014 is projected to be relatively buoyant, supported by fiscal stimuli, strengthening global environment, strong inflows of foreign direct investment, and household consumption. However, there are risks to this growth forecast emanating from weak bank credit growth. Given the current projections of annual core inflation and real GDP growth, the Bank of Uganda believes that a neutral monetary policy stance is warranted in March 2014. Therefore, the Bank of Uganda will maintain the central bank rate, CBR, at 11.5% in March 2014. The band on CBR will be maintained at plus or minus 2 percentage points, and the margin on the discount rate at 3 percentage points on CBR. Consequently, rediscount rate and the bank rate for March 2014 will be 14% and 15.5% respectively.